Hello traders, Gary Wagner here. Approximately 11 a.m. in Honolulu, 5 o'clock in New York City. It is April the 13th, Friday. And this is the daily report for gold and silver, our weekend review. I guess we could characterize this week's trading activity best with an analogy of a roller coaster. This market has been all over the place, down currently across the board in the precious metals markets. As we go into the close, we're off about $16 in the gold market, currently trading $1657.88 as you see on the screen. Kitco has our bid at $1659.10, $1660.10 is our ask. Again, down $16.20 on the day. Net change almost 1%. The low was about 49, $1649.70, and the high was $1678.40. Silver off over 2.5%, 2.66, off about 86 cents. As you can see, current print on the board right now is 31.49, and we also have platinum and palladium off on the day. Today, the markets are reacting to fundamental news in the European Union, but they're acting as a risk-off investment rather than a safe haven investment. The other thing that we'll talk about today, of course, is the dollar index. This is a 432-minute chart, the dollar index itself, and you can see the kind of movement that we have seen, these long green Henkin candles. It has moved back up and is at 80 on the index itself. Traders, looking at gold over the week itself, the first thing I want to do is, this is a daily chart. It is in candlestick but Henkin format, meaning the Japanese average. And the big difference between a Japanese average chart and a straight candlestick chart is the use of the prior day's midpoint as the open in a Henkin candle, as opposed to open, low, high, and close, which are the fixed points in a standard Japanese candlestick. Wow, why is that so important? When we take a look at our daily chart in Henkin format, we had a $16 down day, but when you compare it to yesterday's midpoint, because it was so strong, you can see that it still comes out as a green candle. Now, the interesting thing is, watch as I simply remove this study, and what is going to happen, of course, is we're going to now convert it to a standard candlestick chart, and you can really see what kind of week we had. This down here is a mistick. 1611 was the low. But if you look, now we have this two-day pattern that's simply known as an engulfing bearish right in here that was not evident at all because we compared the midpoint of the prior day's candle to fix as the open on the Henkin. You can see that through the week itself, we had a very, very strong showing in the gold market, Monday, Tuesday, Wednesday, Thursday, this being Friday. So when we actually go ahead and convert this into a weekly chart to see the net gain or loss on the week, it looks a little bit different, because here we get what's called a piercing line, in that it opened at the close, of course, because it's a continuous contract, 24-hour contract, but closed well above the midpoint. Now, in either the engulfing bearish or a piercing line, these reversal patterns require confirmation. Confirmation would look like a green candle with a higher low and a higher high. When we consider the engulfing bearish, you would have to see a lower low and a lower high on a daily candle, because that is where we identified that pattern. Traders, you know that all week on our daily report, we have been talking about the fact that what has been identified, what type of correction we have actually begun to recognize as it unfolded, was known as a triangle correction. Now, with R.N. Elliott, the way he defines a triangle correction, there's a couple of rules. First of all, there is going to be a series of waves, and these waves he calls legs, numbered 1 through 5. It will terminate close to the apex of the triangle, and then the last line is simply called a thrust, meaning it breaks through the upper resistance band of the triangle, right in here, just like that. So the way that this particular pattern would play out, you have your record top here. This is 1920. And you get the market making a drastic low, coming up but making a lower high. And then this is the bottom then, or the beginning of the support line itself. And this is identified as 1, wave 1 right in here, 2, 3, 4. Finally, the fifth wave, our thrust right in here, and that's going to break above the resistance line close to the apex. And as in any compression pattern, once it breaks out of that range, you get a release of the energy that has been built due to the fact that you've had a price compression, as you can see right in here. A couple other things that he identifies, and that is that when you have, this is our major fourth wave here, but when you have a complex correction on wave 4, wave 2 should be a simple correction, and alternating. If 4 is simple, wave 2 will be complex. The interesting thing when we consider this pattern is that it really tends to make a lot of sense in terms of the activity we have seen recently in the gold market, because we are not getting a straightforward retracement as we originally thought we could identify, meaning our A, our B, our C, and then at C we have a conclusion and we go into the impulse phase. Well, how do we know that we haven't gone into the impulse phase? It's simply put, if we had this first wave, this rally here would have had to exceeded our price point of the prior high, meaning right in here. We didn't get that. As you can see, we pretty much saw this market as a double top. That was our first indication. The second indication, of course, is when the market sold off, the low that it made is going into the prior wave counts territory. So that would negate it also. The key to this type of pattern is that you have a series of lower highs, higher lows. It is a compression pattern, and as it gets closer to the apex, we are looking for a major break in the market, and it's typically to the prevalent direction of the current trend. Now, traders, this is the same view of this compression triangle correction. However, it is in a weekly chart, Japanese average format, Henkin format, and the reason for putting this up on the screen and using this as an illustration is when we take a look at how this market's traded long term. This is our support line. If you notice, it's going back all the way to 2008, the latter part of 2008, and there's no doubt that there was a very, very strong channel within the marketplace itself. As you can see, it traded within a range as it moved up, and it wasn't until we got to our recent trading activity that we broke well above that channel, as you can see right in here, and that's that record top. Traders, lastly, I want to look at the silver market. Silver market's been an extreme roller coaster ride over this last week. First chart we'll take a look at is our daily chart. This is straightforward Henkin format, and you can see that we've had one alternating candle color, not really large candle size, tails, no clear direction whatsoever. When we remove this indicator, of course, and look at a straightforward candlestick chart, we see a quite different picture. We see a market that could have been characterized at the beginning of the week as very tight trading range, alternating candles, meaning up close, down close, then this very, very strong finish yesterday, and then very, very weak finish today. Look at the candle sizes when you compare them to the prior trading activity, and in fact it is known as an outside trading day or an engulfing bearish in terms of a straight candlestick pattern on our daily chart. This market itself has been all over the board when you consider the kind of moves we saw over the last 2 trading days, today and yesterday. We had substantial gains yesterday and pretty much gave everything back today. What is critical to me is a couple of benchmarks that we've talked about at the beginning and midpoint of this week that I feel the market has to be able to, on a closing basis, move above. We saw it yesterday, but we gave it back today, and that is 31, call it 31.75, 31.80. Market closes at 31.49. It really needs to close above this point and have this become support as opposed to resistance, because my fear is without that, it will come down and test a couple of new lows rather than being able to move higher. Straightforward resistance 32.50 on the upside, and then about 33.10. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.